I'd like to introduce our next presenter, who's coming in on Zoom, Leigh Anderson from Farm Credit Canada. Leigh Anderson is a senior economist at FCC with experience in agricultural markets and risk. He specializes in monitoring and analyzing FCC's portfolio, industry health, and providing industry risk analysis. In addition to his speaking engagements on agriculture economics, Leigh is a regular contributor to the FCC Economics blog. Leigh came to FCC in 2015, joining the economics team. Prior to that, he worked in the policy branch of the Saskatchewan Ministry of Agriculture. He holds a master's degree in agricultural economics from the University of Saskatchewan. So we're excited to see Leigh's presentation, and I will let Leigh take it away.
All right, good morning, everyone. Is the sound still good? So good morning. My name is Leigh Anderson, Senior Economist with Farm Credit Canada, based out of Regina, Saskatchewan, but we cover everything ag across the country. So excited to be doing this today via Zoom, and just going to highlight over some of the trends in the ag economy that we are monitoring and that could impact your operations, with a big focus on our economic outlook for 2024, kind of across the country, what we're seeing. You've already heard for a lot of the outlooks for potatoes, so mine will be more on some other sectors, primarily grain and oil seeds. First, though, we'll just get into some other topics that we'll be discussing. Of course, the macroeconomic environment is very important, and everyone is interested in that. So here we're going to go through inflation, where it's been, where we think it's going to go, and of course, interest rate trends and what you can expect for the remainder of 2024. Then I'll get into some preliminary profit projections for, of course, Canadian ag for 2024, and what we are seeing and what may impact your operations. And of course, a hot topic is always farmland values. We're going to finish off with that at the end. So just to get into inflation, where it has been the last several years. So during the pandemic, inflation was relatively low and stable. Following the pandemic, when everything opened up, this is when inflation really took off. People came out of their homes and started spending everything from food and everything else, and it's been a hot topic lately. You can see how high it went, peaking in those times in 2022. But nonetheless, it still remains relatively high and above the Bank of Canada's target. The good news, just 2 days ago, Stats Canada did release that the latest inflation numbers for January, they actually came in lower than expected and lower than the Bank of Canada was thinking, at 2.9%. So we're headed in the right direction, and this is good news. Now, there's still a lot of caution around this one number, because the other thing is it's just 1 month. They want it to continue coming down and not see it actually tick back up. So this is where it's still needs to go a little bit closer to that Bank of Canada target, around that 2%. Having said that, our team of economists at FCC, we are forecasting that the Bank of Canada rate, it has peaked, but rate cuts, we are not expecting them until the second half of 2024. The marketplace has already priced in rate cuts sooner than that, but as we had just seen on where inflation has been, and it's not in their target range yet, that the Bank of Canada is going to be cautious going forward, is our view. Now, we will see rate cuts in 2024. We are forecasting a 75 basis point cuts by the end of the year, but these are not likely to start occurring until about Q3 of this calendar year. Now, the rate that everyone else borrows at, of course, in the room, is not the Bank of Canada's policy rate. You borrow at that rate that's kind of a mixture that I'm showing on the screen here, of a mixture of variable and fixed. And those are, just below 7%. And of course, other products can be above that. Now, everyone has, of course, been impacted by the speed and how fast rates went up. Now, if we just kind of circle back, what does this mean for, a 5-year mortgage rate? If we look at historical, we're now at pre-financial crisis level. So go back to 2008, 2009. This is starting to be a long time. We've had low rates for a very long time, including the pandemic low rates. Now, go back to the early 2000s, we used to think this was a good mortgage rate back in early 2000s, anything above 7%. So usually what I say here to a lot of producers is there was a lot of tight farm margins back in the early 2000s, and a lot of operations still got through those periods at these interest rates. Now, we in discussions with producers, we do understand that asset values are quite a bit higher than they were in the early 2000s, so there is a little bit a difference there. And of course, the how fast rates have gone up from the pandemic lows. Anyone coming up for renewal, that is a pretty big shock. Which brings us to kind of this question that we always seem to get from producers and everyone else out there is, what's a good borrowing strategy? Do I go variable? Do I go fixed? And our answer is it really depends on your unique situation. And one thing that we highlight is probably to have that timing and structures of your various loans on your farm, not necessarily all coming up for renewal at one time. So as a rule of thumb, you could say have anywhere from 10 to 15% of your loans coming up for renewal at one time. This is kind of a natural hedge depending where interest rates actually end up over time. And with that, some of them might naturally fall up off the books, giving growth opportunities when land or other things do come up for investments. Now, of course, it's all about cash flow. Every situation is unique, and everyone's individual level of risk. And of course, we're also saying you can do some sensitivity analysis, and what you like for your operation is if you did stay variable, what would happen if rates went up or down, and what would that mean to your cash flow? Or when you are coming up for renewal in a year, what are some rates that you could potentially be occurring at the time, and can your operation sustain those? Now back to the Canadian economy. The Canadian consumer, of course, is now under tremendous pressure. Coming out of the pandemic, household savings rates were actually quite high. People were stuck at home, couldn't spend their money. Now where we are today, those rates are now getting close to pre-pandemic savings rates. So high inflation, people are eating through their savings. And on the other side of it is also that debt servicing as a share of Canadian national disposable income is hitting new records. So just think about the average Canadian consumer coming up for mortgage renewal. It is starting to take a good chunk out of their disposable income. And this is going to add to the Canadian economy weakness going forward for the rest of this year and into 2025. So that's why we're saying the Canadian economy is slowing down, and it's going to continue to slow down. Now, this is kind of some good news, and this is where the Bank of Canada wants the economy to slow down, that it was too hot, that was causing inflation. Now, our team's forecast for where 2023 ended versus what the Bank of Canada was saying, we're saying it actually grew a little bit more than what the Bank of Canada said, but nonetheless very close. We're at 1.1. They're saying it grew about 1%. Now, going into 2024, we're saying things are actually going to slow down faster than they are. Just that growth was more front loaded in 2023. Now, this was in the news a week or two ago that they were hinting that Canada was going to stop their quantitative tightening. And our team is not seeing that, or what we see today in the economy, that there's still a lot more unwinding to do. This is the Bank of Canada's balance sheet. That the liquidity they pumped into the economy during the pandemic, they still have a ways to go to get it back to pre-pandemic level. So we're not expecting that to end anytime soon. So what is this? They go back into the bond market and unload those assets, and that does impact fixed rate lending. Now, what would occur them to stop it sooner than planned would be if there was, a major recession in Canada, but our team is not forecasting that at the moment. Now, there's a lot of headwinds still out in the economy that the Bank of Canada, of course, is watching. And this could be, of course, those headwinds that could keep inflation a little bit higher. One of the main ones is Canadian population growth has accelerated due to immigration levels. And it's been very significant coming out of pandemic, where it kind of stalled, where immigration wasn't coming in. And has a huge implications for Canadian housing. And that is also adding into that inflationary piece. The other big headwind, of course, the Bank of Canada is watching, is that wage growth actually remains relatively high and is still, keeping up with inflation. So they kind of go hand in hand together. That of course workers are demanding higher wages to combat inflation, but it also can cause inflation to stay higher than the Bank of Canada wants. So on the screen here, we're showing what it was, in the 2016, 2019 average, about just over 2%. And now we're close to almost double that at 4.4%. Now, this is on the Canadian average. Of course, in like agriculture and some of those other sectors, wage growth has even been higher than that, just to attract the talent that processors need or farm laborers need for attracting that. So, of course, this does remain relatively high and is a headwind that is on our radar. Now, what our team is forecasting for the value of the Canadian dollar for the remainder of 2024, we're actually saying it has potential to appreciate in the second half of 2024 relative to where it is today. Now, a lot of this is really due to just the strong momentum that the US dollar has right now. And what we're saying here is that once the US Federal Reserve, like Canada, starts cutting their interest rates about that same time period in Q3, it's just going to lose momentum. And that's all that we're saying here. And it's, just slightly higher than it is right now. So not a big difference, but it can increase slightly for the value of the Canadian dollar. Now, this is important with a lot of the commodities Canadian farmers grow, because a lot of them are marketed internationally into the globe, which are priced in US dollars. So it can push commodity prices lower. On the flip side, it can make equipment and farm inputs cheaper to import. Now, that brings me to the end of the macro section. So the takeaway here would be economic weakness is going to continue into 2024. Borrowing costs have likely peaked, but interest rates aren't going to come down until that Q3 of 2024, and by the end of the year, you could see 75 basis point cuts. So the next section we'll go into is our team's forecast for profit projections for Canadian agriculture. Of course, it's still relatively early for the year, but what we're seeing today, and we do make a lot of assumptions here that just kind of give a general trend of what we're seeing or what you may expect on your operations. So just to kind of recap what 2023, at the national level, Canadian grain, oilseed, and pulse production, it actually came in relatively good and higher than expected. So what we're showing on here on the screen, it was about 7.5% lower than 2022. A lot of that occurring in, of course, Western Canada where there was a drought, but then better than expected. So that actually isn't too bad. And when you compare it to the 5-year average, it's only 2.2% lower than the 5-year average. So up a lot higher than the 2021 drought in Western Canada. Now, of course, weather remains a big watch item across Western Canada and, of course, the US. Going into the US, though, they're starting to see moisture improvements where they were from at the end of 2023. The US Midwest is starting to get moisture, so it may appear that they're getting enough moisture to get, their corn and soybean crops in and established. Of course, it will depend on in-season rains for how that crop will materialize going forward. Now, back into Canada, of course, Western Canada remains very dry, especially into Alberta, but other parts of it are actually starting to look all right. And then you go into Eastern Canada and Atlantic, where they had the moisture conditions or even too much moisture. Of course, that is still on our radar for what could happen throughout the growing season. Now, what is our team looking at for input cost? We are expecting them to be lower on average for the 2024 crop, but they are dependent on global factors. And there's a few things that we are monitoring going forward. We are seeing fertilizer prices come down, potentially China even opening up phosphate exports, which would be good news. But at the same time, we do know that there's some other issues that could impact prices as seeding approaches. And of course, that's seasonality where fertilizer prices can tick up just slightly right at seeding time. On the fuel side, fuel prices have come down a little bit, but at the same time, they are staying a bit sticky, especially on diesel relative to gasoline. Now, here's some geopolitical issues that are more on our radar, but have the potential to impact the global economy and, of course, agriculture markets going forward. The war in Gaza right now isn't too big of a concern. The concern there is if it spills over to further into the Middle East. U.S.-China relations always on our radar. U.S. and China are two heavyweights globally in agriculture, both in U.S. being a major producer and China being a major consumer. So we're watching that. Trump has indicated if he is reelected, he would apply a 60% tariff to, of course, China. We would view this as inflationary, and of course, you would probably see retaliatory tariffs go on as well. So, of course, that is on our radar. Anything that happens there. The war in Ukraine, going back to 2022, significant premiums in the grain and oilseed market. Those are no longer in the market. Exports coming both out of Russia and Ukraine continue to get traded around the world, so there's no more war premium. And this has also reduced grain prices what we're seeing today and going forward. On the Canada, India, there was some political tensions there. Those have kind of they were on our radar, but India's food inflation has been relatively high that they've had to actually temporarily reduce our pulse tariff, which is good news for our pulse growers in Canada. Even though it's temporary, we are seeing some relief there that they need to bring down their food inflation in India. Now, going back to the war in Gaza and Middle East region, what is on our radar here is that if it escalates further into the Middle East, this would probably immediately impact crude oil prices, which of course would impact the value of the Canadian dollar. But the other thing that's on our radar is the Middle East region is responsible for about 50% of global urea exports. So this would have probably an impact on the fertilizer market if that did occur. Now, we are getting very close to spring and seeding time, so we're almost thinking that it's not going to impact it for this crop year, that most of those supplies are already booked or on their way to get into Canada for especially in East and Atlantic Canada. So those prices are probably going to be okay going forward. The other big one that we are monitoring is, of course, supply chain issues. Again, back into that Red Sea area, we're seeing a lot of reduced traffic on the Red Sea. Not that Canada is a big user of that seaway, but it does impact global shipping rates. A lot of insurance companies do not want to insure vessels going through there, so they're forced to go all the way around Africa, which adds significant costs and 2 to 3 weeks onto their journey. Now, the fear and the impact to shipping costs would be if it keeps lasting longer than anticipated, right? So if it goes on for weeks or months, shipping costs globally are going to start to continue to creep up just as global shipping capacity is reduced. So you may already be seeing that in, of course, the container market, because 30% of containers go through that region globally. Now, even Black Sea exports, so think Ukraine or Russian wheat, if they have to go around Africa, this is also meaning that they have to reduce their grain export bids or offers, and this is having an impact to all global grain prices and trending them lower. The other one that's on our radar and is impacting more U.S. Grain exports through the U.S. Gulf are reduced Panama Canal transit. The water levels on the lakes that feed the locks there have reduced the number of vessels that can transit per day. U.S. Grain Council estimates that for every day a vessel has to wait, it adds about 50 cents US a ton per day. So that does add up, and that also backs up onto farm gate prices. Now onto our grain and oilseeds markets, where we've been for the last several years, coming off some very strong highs and prices following Russia's invasion of Ukraine, and where we are today, we're continuing to see continued weakness through 2024. Now, a lot of this also stems from start with U.S. corn. The USDA did surprise markets back in January when they came out with U.S. corn production estimates saying, despite the drought, U.S. Corn producers produced a record crop and record yield. Basically, the takeaway here was there's no shortage of corn feed supplies for going forward, that the market is comfortable with what is available. And this is pressuring our feed grain prices here in Western Canada and Eastern Canada. Same thing then going to wheat future prices. Again, going to Black Sea and other regions, just no shortage of wheat in the world, and our bids in Canada have to be competitive globally. So we're seeing weakness there as well. And similar story with U.S. soybean futures; those are continuing to decline. No shortage of soybeans in the world. There was early concerns of South American soybeans. There no longer is. There seems to be adequate supplies there. In terms of canola, of course, for Western Canada, those prices continue to decline. What the market does think that there's more canola out there than Stats Canada is reporting, that production was better than expected. So we're continuing to see weakness there, which is following the soybean futures down lower, and of course has to remain competitive to other oil seeds such as palm oil globally. Now on the flip side, when we look at the livestock market, U.S. cattle futures continue to reach record highs. And now this is really driven from a very small North American herd. U.S. has continued to cull their herd given the droughts of the last few years, and same thing here in Canada. Western Canada was also sending a lot of heifers and cows to slaughter because they didn't have the pasture and the feed supplies last year. And it just takes time for rebuilding herds, and it's going to last for anywhere from 2 to 3 or 4 years. That's good news for our livestock sector. Now, a little bit different story though when we look at U.S. hog futures prices aren't necessarily they're still relatively good, but there's just too many hogs in North America and globally. Globally, China has increased their hog numbers, and North American just right now is producing too many hogs. Hog sector seems to go through kind of these cycles where we boom and bust periods. We're kind of in that period now to just some readjustment that will occur. The good news for the hog sector is those feed prices are coming down, which some hog producers can still price in some profits going forward. Our Canadian supply managed sectors, broilers, milk, eggs, those ones are usually relatively stable. Again, reduced feed costs here are going to be driving some of those margins going forward. In terms of the broilers and eggs, the growth of the Canadian population is really good news for those sectors that are geared for domestic market. Broilers did increase their support price mid-January in Ontario. Most provinces usually price off of the Ontario formula, so that is starting to show up in some revenue there as well. Canadian dairy sector, they have delayed their support price increase, I believe, till May. It typically occurs in February, so that it's coming. It was just delayed for those producers. Now, this is our forecast for a few select cash crop costs for what you're seeing at the farm level. Now, these are for Western Canada, but I would say that it would be generally the same for trend across Canada that you would be seeing. Expenses have softened. We're forecasting fertilizer prices to come down a little bit, and this will depend on the timing of fertilizer purchases at an individual farm. Chemical prices is the biggest one that is what we have seen come down pretty much across the board for most chemicals. Seed prices kind of a bit sticky there. A lot of them are set back last summer or last fall when seed companies are preparing their stuff for the coming year. Now they have softened a little bit, but they still remain elevated. We would have heard 2022, 2023 most expensive crops ever put in the ground would have been similar for potatoes. So we're still seeing that expenses remain elevated. So when we put this together with those softer prices, there's a lot of weaker margins that are expected for 2024. Of course, it always comes down to what are actual yields and prices that producers will be selling at. So throwing up here for all of Canada, just some major crop rotations across Eastern and Western Canada. 2024 is looking relatively tight. Our margins are excluding land costs. Land costs really vary significantly from one operation to the other, but it gives producers an idea of what is left over to pay for land costs. Even in PEI there, you might be approaching close to, anywhere from that $150 to $200 per acre on probably some land rent or land payment costs. So that's starting to eat into those margins relatively good. Now we will say for like 2023, our margins are showing that they're a little bit lower, especially for Western Canada on a canola wheat rotation. Now, that our margins do exclude crop insurance and any agri stability payments, so that would prop up some of those returns there as well. Now, what we're really highlighting that as we're getting into a tighter market environment with prices continuing to be pressured, that's really going to come down to a lot of farm management decisions. What can you do on your operation to get maybe yields a little bit slightly higher without incurring more cost? And can you market at a slightly higher price? Sometimes you can just do, a couple percentages can go a long way in supporting that or maintaining strong margins. One of a big focus for a lot of producers, especially in the grain and oil seed, is equipment costs have continued to increase. And you take that in with higher interest rates. This example is for a new Class 8 combine, semi-annual payments that I'm showing on the screen here. You go back to 2019 to maintain an equivalent payment that was zero down back then, your semi-annual payment, you'd have to put in anywhere from 30 to 35% more cash into the deal to make your payment still the same on a per acre basis. Now, of course, there's a lot of assumptions that go into this. Other options are that we're seeing producers do is lengthen their replacement cycle of equipment. Now, when you do that as well, you have to think about what your repair costs are or your depreciation rate on those equipment as well. So really comes down to every operations, what works best for them. And we have seen a lot of producers even indicate they won't be buying new equipment for, if they were on a cycle of getting something new every year, they're now extending that to sometimes 2 or 3 years, or looking at the used market. So really do what works best for your operation. Calf sector profitability expected to stay strong. Now, this does depend on feed availability across all of Canada, but nonetheless, there's some strong margins that are expected for 2024, and I would expect this to continue into 2025. Some very strong profit margins for the cow-calf sector going forward. Now, back to what we said was impacting the cow-calf, or just the fed cattle future prices in the U.S. and driving prices higher here. Just that North American heifer and cow slaughter rates are at decade highs. U.S. Cattle herd is at 60 and 70-year lows. USDA did come out a few weeks ago saying that the U.S. cattle herd did shrink 2% for January 1st, 2024. Now, when you throw in our estimate for Canada as well, I think Canada's estimate will come out later this month, but we're saying it's going to be in a similar situation where, over 50% of heifer and cow share of slaughter is occurring, and this is having an impact on the beef herd size. And this is why you're going to see prices continue to stay high, and it just takes a while for those new heifers that are retained to grow the herd going forward. So our profit projections for Canadian ag, on the crop side, production and supply appear to be returning to normal levels. Hence, we're seeing such a decrease in prices across the board. So we're going back to a period of tight prices, and producer management is going to be key for inking in some profits for 2024. On the livestock side, really good news there. Feed prices are eating, especially on cattle where the supply remains tight. Hogs is a bit different with high hog inventory. Nonetheless, some reduction in feed costs will be supportive for the hog sector. This brings me into the next section where we're going to talk about farmland values. So just recapping for 2022 Canadian farmland values that came out about a year ago. In Atlantic provinces, we did see some strong appreciation, PEI almost at 19%, and then New Brunswick very similar, Nova Scotia a little bit lower, but and closer to that Canadian national average. Now, of course, within your own regions, you're going to see it a little bit different, but nonetheless, farmland still is appreciating it at some very strong rates across the country. Now, what did we see at mid-year when we released these in October? We didn't have enough transactions to see at a 6-month period for Atlantic Canada, but if we look at what was occurring in other provinces and at the national average, and then at what we were a year ago, we'd anticipate that Atlantic will be somewhere in between there of that, close to that probably 12, 13%. And of course, you could see higher rates in certain regions closer to your farm. Now, what is the impact of rising interest rates on newly purchased farmland? So if we make some assumptions where farmland will continue at some of the appreciation rates that it has been and higher interest rates, relative to the long-term average, you're going to be closer to 20% of your gross crop revenue will be going to farmland payments. Now, we're making an assumption that you're taking this over 25 years, 25% down on this, but it's going to take a bigger chunk of your gross crop revenue going forward. Now, this is also including corn, soybeans, wheat, and a potato rotation in these assumptions. If you pull out probably some good returns off of potatoes, your percentage might be even a little bit higher. But nonetheless, it's about that trend for 2024 because of higher interest rates is impacting the amount of gross revenue going to farmland payments. Now, on the flip side, though, when we look at the balance sheet of ag and where we ended for 2022, Atlantic farmers have been sitting in equivalent of about $500 million in excess cash. Either it's cash equivalent or kind of just on the balance sheet compared to a long-term ratio. So this sets actually producers up to withstand a slowdown in commodity prices to get them through a tougher period. And while we're saying that farmland values are going to continue to remain relatively strong despite probably some weaker margins in the grain and oilseed sector going forward. Now, this is for 2022, 2023. That ratio might have come down a bit, or some of that cash may have been used, but nonetheless, there's some strong financial positions of a lot of Atlantic farmers out there that will get them through some of the tighter margin period. Now, our farmland values report will be released on March 12th. And then a week later, our chief economist, JP, will be going through the report's key findings, and that is virtual. So you can go to our website, and I think you can sign up for that if anyone's interested in watching that. So that brings me to the end, and I'll just recap what we are seeing for in Canadian ag. Economic weakness will continue. Borrowing costs have likely peaked. Interest rates not coming down until that second half of 2024. Probably a 75 basis point cut is what we're forecasting right now. On the crop side, prices are continuing to be tight with global supplies and production returning to more normal levels. So no really concerns there in the world. Of course, that can change at any time given global weather as it can any year. Livestock feed prices easing, which is really good for our cattle sector. But the hog sector is going through still high hog inventory levels currently. And of course, back to farmland values. There's a lot of lower listings that are supporting farmland values. So for every listing, there seems to be multiple buyers willing to step in and pay some of those higher prices to get it, even with some of the higher interest rates and interest rate payments that I showed a little while ago. We are, though, seeing a shift in growth away from the higher price land, and that's the lower price land. It seems like doing a catch up. Strong farm receipts the last few years and balance sheets are providing support to the sector. That brings me to the end, Ryan. We'll see if there's any questions or happy to entertain, or if that's all we have for today.
Yeah, we got time for a few questions. Rodrigo's going to have the catch box. So if anybody has a question, you can raise your hand and we'll throw you the box. Or if you're close by here, I can take this mic to you as well. But we have some time for Some questions for Leigh? Any questions? Don't be shy. I have a question, Leigh, just in terms of, we did see this big spike in costs, through the pandemic and then coming out of the pandemic. You see fertilizer prices that are starting to moderate there a little bit. Fertilizer, not all fertilizer is, fertilizer comes from different places. So, phosphate and potash and urea, you mentioned urea, a lot of it's coming from the Middle East. Is FCC tracking, that sort of availability and whether that's going to have a big impact on costs here in the next little while? Or is that improving or tightening, or where do you see that going?
Yeah, I think I think the supply is relatively good, but of course we are going to be monitoring water levels on the Mississippi that could impact imports of fertilizer that come up there, or just push prices at seeding time or in place for seeding on fertilizer supplies. But most global supply is sufficient relative to demand. Global demand for fertilizer has also declined. We're seeing tighter margins. A lot of other producers around the world are also, and that they are adjusting their fertilizer consumption as well. So of course, we're all going to be watching a lot of that going forward too.
Okay, we have a question over there on the other side.
No, a question I had was the 2% target on inflation that's been around for a long time. Is that realistic to ever achieve again, or is it carved in stone as such that it must happen before we can get back to equilibrium?
The Bank of Canada is still, that's their midpoint, so 1 to 3%. So they can go to closer to 3 when they're watching it, and they might, as we go forward, take that into consideration with, you're right, with higher wages and everything, keeping it probably closer to 3 than probably 2%. I don't know off the top of my head when they review their next round for their longer term policies of adjusting that, right? Where they do meet occasionally is 2% still a target that they should be considering? It is for now.
Any other questions? Okay, if not, thank you very much, Leigh.
All right, thank you, and enjoy the rest of your conference.